In this video, I'm going to share with you exactly how government bonds work. I'm going to show you why government bonds sometimes fail and what you need to do to prepare. Don't worry, there is no FUD going on here. Anything we're talking about in this video is a long way off. So first, how government bonds work. The United States Department of the Treasury issues debt. It borrows money. And when it issues this debt, it will repay that debt anywhere from 4 weeks from now until 30 years from now. Depending on the length of maturity, when they're going to pay that debt back, that debt gets a different name. The short-term debt that matures in 1 year or less is called a bill or treasury bill or T-bill. Debt that matures in between 2 years and 10 years is called a note. And anything longer than that, like the 20-year or the 30-year, is called a bond or a treasury bond. Now, in everyday usage, many people will call all of these things treasuries. Now, if none of that makes any sense, just replace with this. You give the government $1, they will give you an IOU for $1 and let's say 4 cents. All treasury bonds, T-bills, notes, these are all just IOUs. They will all have a date on the IOU showing when that IOU is due, meaning when they'll give you your dollar back, and the yield or the interest rate that they pay you is an annual interest rate that they will pay you every single year until they pay you back your full dollar. And spoiler alert, when they do end up paying that IOU back to you, many times they're only able to do that because they give a new IOU to somebody else. So that makes sense. It's essentially a giant Ponzi scheme. I mean, it's the foundation of the global financial system. Now that we understand that, how do the interest rates on these IOUs rise and fall? Well, you have two main forces that are acting on interest rates for government bonds. You have the Federal Reserve and you have the free market. Contrary to popular belief, the Federal Reserve does not control all interest rates. The only interest rates they control are the absolute shortest term interest rates for banks to borrow and lend to each other overnight. Now, while it seems like this would have nothing to do with the government, it actually does, because it influences the rate at which the government can borrow, especially at the short term. So when the government issues IOUs that are due to be paid back in a month, or in 6 months or a year, the interest rate on that debt is going to be heavily influenced by the Federal Reserve's interest rate. This is because if the government doesn't offer an interest rate that is better than what the Federal Reserve is offering, then banks will lend to the Fed instead of the government. And so if the Fed lowers the interest rates that the Fed is paying, then it allows the government to offer a lower interest rate as well. The banks are going to be flush with cash either way, and they're always going to be choosing where the best place is to place all that cash. So as the Federal Reserve lowers and raises short-term interest rates, that will influence the rate that the US government borrows at the short end. The second force that is acting on interest rates that moves them up and down is free market forces of other individuals and institutions and even nations buying and selling US government debt to each other. Remember, at the beginning I said the government issues IOUs. You don't have to keep this IOU. You could then sell that IOU to somebody else. If suddenly, for one reason or another, there is a lot of demand for US government debt, you might be able to take your IOU and sell it to somebody else at a profit. Maybe you lent $1 to the United States government, but you can sell that thing for $1.01, $1.02 immediately right now and make a quick profit. On the other hand, sometimes nobody wants to touch these IOUs from the government, so demand for them goes down. You might be in a position where you have to sell it anyway, which means even though you lent $1 to the government, you might only be able to sell that IOU for 98 cents or 95 cents to somebody else. You're going to take a loss on it. And the reason why you're selling it right now is because you need the cash right now. You can't wait until it matures and the government pays you back. As this buying and selling of all existing government debt happens, the price of that existing debt goes up and down. Therefore, when the price goes up and down, the yield that that debt itself is paying will go up or down inversely, oppositely compared to the price. Because when that debt matures, it's going to be the same dollar amount that's going to pay out at the end. So if I have an IOU where I lent $1 and I have to sell that thing for 95 cents, the interest rate on that thing went sky high because the person who bought it from me at 95 cents is going to sit on it and they're going to get paid back $1.04. So they're going to get paid a 9 or 10% interest rate on that. Okay, so that makes sense. The Federal Reserve and market forces influence interest rates that the government pays on its debt. But how does it actually pay the interest on this debt? Because as we talked about earlier, the US government And most governments are only able to pay you back what they owe you on your IOU because they're issuing other IOUs to other people and getting dollars from them. Now, in a normal environment and for every free market participant, debt is paid with income. You and I would not be able to do things the way that the US government or other governments do things. It would essentially be like you opening up a credit card, maxing it out, and then paying off your balance by opening up a new credit card and maxing that out by paying off your old balance. Well, now you've got a little bit more on this credit card that you just opened up because you also had to put some extra expenses on that. Now you have to open up a new credit card and pay that off, and you're constantly rolling it over from credit card to credit card. Well, eventually the lenders are going to catch on. They're going to realize you don't have the income to pay off this debt, so they're not going to allow you to increase the amount you're borrowing from there. And if you really can't pay it back with your income, then by definition, you are bankrupt. But governments are a little bit different here because they don't actually have income at all. A government cannot create value, nor can it produce income. So what they have to do instead is they have to take income involuntarily from somebody else who has produced income. And we call this taxation. When this process happens anywhere outside of the government, we call it extortion, but if it's good old Uncle Sam doing it, we call it taxation. So in a normal environment, a government will pay back the IOUs with a mix of taxation and extra borrowing. But most governments around the world are in a similar situation to the United States government, where you don't have anywhere near enough tax income in order to pay back those IOUs. You're using all new IOUs to pay off those old IOUs, and then some. And even for governments, eventually the road runs out on this process as well. You cannot keep on doing this indefinitely because at the end of the day, at some point, the lenders will dry up and people will stop loaning you money, even if you are a government. But before we get to that point, governments always try one more last ditch effort. This is kind of the final phase of the sovereign debt crisis, and this is paying the debt back through printing. Instead of declaring bankruptcy or trying to restructure the debt, they'll just print some extra money and use that to pay their bills and use that to pay off some of the IOUs. Now, this can work temporarily as long as they don't do it too much or for too long. But one of the main problems that comes up is the problem of inflation. Eventually, all of that new money works its way into the economy and it bids up the prices of goods and services. People think there is an economic boom happening for a while until they realize that prices of everything are going up. And it's really the erosion of the purchasing power of the money that they're seeing and not economic progress. In other words, it takes more money to buy the same amount of stuff. Eventually, people start to catch on and will get rid of money as soon as they can in exchange for buying things like assets that will protect them from currency debasement. And if things get bad enough, people will even dump the currency for goods. As this happens, you see a rush to buy assets and goods in an effort to just escape the currency, which is a little bit of a self-fulfilling prophecy because all that extra demand keeps on driving prices higher and higher. And if this process continues, eventually the government defaults anyway because the only thing they have to pay you back with is their worthless paper and nobody wants it anyway. Now you might think this would never happen to the United States, but it actually did. That's where the saying "not worth a continental" comes from, because after the Revolutionary War, all of the founding fathers saw the direct results of hyperinflation because they hyperinflated the currency at the time, the continental. And fun fact, that's why in the Constitution, it gives the government the right to coin money, because in the Articles of Confederation that came before, it didn't have that specific phrase in there, which allowed the printing of money. So when they were framing the Constitution, they said, no way, we don't want to deal with that again. Hyperinflation is the worst. The government can only coin money, meaning metal. That way, they couldn't print it. So given the fact that over the last 4 or 5 years, we've seen incredible amounts of printing, especially in 2020 and 2021. Why has this not happened in the United States yet? Why have we not tipped over into hyperinflation and seen a global abandonment of all fiat currency? Well, there are a few reasons. Reason number one is because the scale of printing is really just not there yet. We got kind of close in 2020 and 2021 when the money supply increased by about 25%. But quite frankly, you need the printing to be much higher than that, and you need it to be sustained for much longer than that. Any example of hyperinflation throughout history that we see, the printing goes on for years, and the amount the government prints the money by continues to accelerate. They don't just stop it, which should make us all thankful that yes, the Federal Reserve has a ton of problems, but at least they stop the printing in 2021. Now, it is true we are headed that direction, but it's not close. And this is not some conspiracy theory either. Even Jerome Powell was asked about this recently in an FOMC meeting. He was asked about the sustainability of the United States government's fiscal situation. And he said, obviously right now it's sustainable because they're paying the bills right now. But he said the path that we're on is unsustainable. Basically, we are headed in a direction that would result in collapse, hyperinflation, an abandonment of the dollar as a global reserve currency if we continue to do what we're doing and don't try and reel it back, don't try and change directions, don't try and slow it down. So we are headed that direction, but we are not close to it yet. The next reason why it hasn't happened yet is quite simply productivity. The average work week in many countries around the world is slowly shrinking. Many places in Europe have 30-hour work weeks. The productivity of many emerging nations is nowhere near the productivity even per capita of the United States. The hard truth is that most Americans are hardworking, productive, resourceful. It may not be what you see online and in the media, but the average American household puts their heads down, gets to work, produces more than they consume, has some unrealistic and unsustainable financial habits themselves, too much leverage, overconsumption. But at the end of the day, on net, Americans overall are still producing much more than we consume and are increasing our overall wealth. An increase in total wealth means that even if the government is siphoning away resources and wealth from the private sector, we're at least offsetting the pain of that. Imagine if the total wealth was stagnant, we were not overall increasing our wealth, and the government was still siphoning away money and wealth and resources, well then we would be experiencing a lot of economic pain. It would be draining our resources. But the American people are a lot harder working than that. Not only are we increasing our wealth for our own well-being, but we're doing it enough that the government can still siphon off trillions of dollars a year, completely wasting most of it, and we're still offsetting the pain of that. Imagine the economic explosion that will happen if we see a decrease in the amount of money the government's siphoning away from us. All right, the next reason why this hasn't happened yet is dollar-denominated debt around the world. Now, when I say this, a lot of times people think I'm talking about the US national debt. That's not what I'm talking about. I'm talking about random people and institutions and countries all around the world who owe debt, they have debt, they owe money, and the money that they owe is US dollars. So how does this happen? Ever since the Bretton Woods Agreement back in the 40s, the rest of the world has slowly been increasing its dollar-denominated debt. Other individuals and institutions and nations can borrow dollars the same way you can borrow dollars. You don't print dollars yourself, you don't control the dollar supply, but you can borrow dollars by promising to pay them back to somebody else who has dollars, and they give them to you. China doesn't control dollars, China doesn't print dollars, but they can still borrow dollars, and they do that by borrowing dollars from somebody else who has them and promising to pay them back with an interest rate. Now, one of the reasons, not the only reason, but one of the reasons why dollars became the default money everywhere is because everyone else had abused their money even more. This is why when you see places like Iraq, they're not borrowing in dinar, or Lebanon, they're not borrowing in Lebanese pound. Venezuela is not borrowing in the bolivar. When countries who have a history of printing and hyperinflating their own currency, nobody else wants to loan to them in that currency because if they get paid back, there's really no promise they're going to get paid back in real purchasing power. That money might be hyperinflated away. In fact, the borrower has the incentive to do that. And so when lending happens globally, especially from country to country, you're going to see a lot of that debt denominated in a currency that neither one of them can control. And usually that's going to be the US dollar. Now, the reason why this kind of pushes off hyperinflation in the dollar is because the only way a dollar can come into existence is by being lent into existence. Dollar is debt. Not only that, but when that debt is due, it is due with more dollars than were created there with that debt because of the interest rate. It's not 0%. So every dollar that comes into existence is future demand for even more dollars because I need to go out there and sell something to get even more dollars than I borrowed in order to pay off that debt. And the fact that there's $65 trillion at minimum that we know about in dollar-denominated debt around the world means that the US government has some big freedoms to be able to abuse the printing press, and all that dollar-denominated debt around the world can kind of absorb some of that inflation. Now, at the end of the day, regardless of how big the barriers are that are in place against tipping things over into hyperinflation, at the end of the day, if you print enough and you borrow enough, you're going to get there. It's just a matter of time. It's not a next couple of years type of thing. It's a next couple of decades type of thing. So in terms of what to do to prepare, don't worry about anything happening urgently. You don't need to dump dollars. You can still have a savings account. Don't go over the FDIC limit. Make sure overall you're still heavily allocated into investing rather than saving so that you don't take a bath from inflation. But even if something like a repricing or a hyperinflationary collapse of the currency were to happen today, you don't even have to worry about your dollar denominated assets. Things like homes and things like cars and things like stocks and even things like Bitcoin, they just get repriced in the new currency. Not through declaration, but just through the market value of those things. Right now, you can look up the gold price of anything. You can look up the Bitcoin price of anything. You can look up the euro price of anything or the Japanese yen price of anything. Whatever form of money people decide to use, if and when the dollar does eventually stop getting used, will be a very seamless transition in terms of pricing. There's no committee, no government, no entity that goes in there and decides what the price of everything will be in the new currency. The value of your stocks will still be the value of your stocks relative to everything else in your life. The only thing that will change is the number of dollars needed to get them, which will eventually go to zero because it'll go to infinity. So yes, we will continue to have a long period of inflation in front of us, just not hyperinflation. You don't have to worry about a collapse of the dollar, at least not anytime soon. So keep investing, keep protecting yourself against the slow but persistent inflation that we will have. And if you need any help with that, join my private coaching group, linked in the description below. As always, thanks so much for watching. Have a great day.